Let's see what's in viewer mail.
We have your mail?
Yes, we do.
Good. If you have questions, please send them to Doug@riskandrewardtv.org. I'd be happy to answer your question. What do we have this week?
This is from Tammy in Lubbock, Texas, and she writes, I hear things on TV about PE ratios and how they can show the value of a company, but I don't really understand them. Is it something I should learn about? If so, can you help me?
Well, I can't help you.
I think
Whether
so.
you have to learn about this or not is up to you. It does give you some sort of idea on the value of a company. So let's just look at this. I pulled one up on Yahoo Finance here, and this is Apple. We're all familiar with Apple. And you'll see right here that it gives you a PE of 16.30. So you can find PEs on pretty much every company. Now, of course, the E is earnings, and if they don't have any earnings, they can't have a PE ratio. So it'd be 0. So P is the price of the company divided by its earnings. And so what it basically tells you is how much you're paying for each dollar of earnings that you're receiving as an owner. So it gives you a value of how much you overpriced or underpriced the stock is. So at Apple, for example, the stock was trading closed today at $412, and the earnings per share was $25.28. So if you divide 412, which is the price, divided by $25.28, you get the PE ratio of 16.30. Now, this is incumbent upon the earnings per share that you use. Now, in this case, Yahoo has used TTM here at the end. You can see where it says TTM here. I'll scroll in. PE TTM. That's the trailing 12-month PE ratio, or the trailing 12-month earnings ratio, or earnings announcement. So this is the last 12 months of earnings. So it's past earnings. Well, we don't care about the past earnings as much as we care about the future earnings. So the professionals and other people will have a PE, a forward-looking PE, about what they think the next 12 months will be as far as earnings, and then they'll put a PE ratio on that to see what they're paying for the future. So it's somewhat misleading to use the PE ratios that are online that are trailing 12 months. And of course, they're not going to give you their guess because they don't have a guess. They're not analysts. So to do some math, you can quickly look at the PE ratio in reverse. So I'm going to take out a piece of paper here and give you a quick explanation of PE ratios. It's P divided by E is the price divided by the earnings per share. So it's the price per share and the earnings per share, so your units are the same. And in this last case, the earnings were 412, or the price was 412, and the earnings were 25.2 something, 28 I think. And if you put that into a calculator, you'll get a 16.30 earnings per share, PE ratio. But now what does that mean? It means that for every dollar that you give the company, every dollar you put in, you get back $16.30 in earnings. So, I take that back. You have to pay them $16.30 to get back $1 worth of earnings.
Okay,
I said it in
better.
reverse. Yeah, I said it in reverse. Sorry about that. You pay $16.30 and you get back $1. So, what kind of return is that? Well, you simply do the math and inverse this. So 1 divided by 16.30 would give you the return on this investment, if that's what they're going to do. You give them $1, you give them $16.30, and they give you $1 back every year. And that answer is somewhere around, I don't have the exact math, but it's around 6%. So in the trailing 12 months, 6%, not very good for a company like Apple, right?
So when you think of Apple and
so
what
you
they
think
could
it'd be
be,
more than
so
that.
you would
Well,
think.
so the trailing 12-month earnings are not what people are betting on, right?
They're betting on the future.
The
What's
price
the new
reflects
technology?
the new earnings. So when you think of the new earnings, well, what would happen in this equation if the earnings went up? Well, if the earnings go up, the number goes down, the ratio goes down, and the return goes up. Does that make sense?
Yes, it does.
So let's look at a different example. I'll pull my charts back up here. Let's see if I can get this squared away. I don't flip them back and forth very often. Let's look at this one. This is Amazon. Now, Amazon, very popular company. Everybody knows Amazon. Its PE ratio is 102.28.
Doesn't sound too good.
102.28. So
No.
it's got a $231 price. It's got $2.27 in earnings, or $2.27 in earnings. And then while we're at it, let's look at another example and look at Applied Materials. Applied Materials is a tech company, so we're kind of all in the tech space. Applied Materials, its P/E ratio is 7.48. So 102 on Amazon, 7.48 on Applied Materials. Applied Materials' last trade is $10.85. So somebody thinks somebody's future is different.
That's a wide variety there.
Right, so let's put that into the equation. We got a dollar over 102. Well, 1 over 102, we know that's 1%, approximately. Round numbers, 1%. Mm-hmm. And then we have 1 over, what did I put, 7.48? 7.48. Yep. That's about 12.5%, right? 1 over 8 would be 12.5%. So 12.5% on Applied Materials, 1% on Amazon, and 6% on Apple. So when you think of PEs, you can kind of get a gauge of how much your money is supposed to return given an accurate earnings forecast.
That would be the key.
That's the key. So will the earnings continue the way they've been going? Will they be higher? Will they be lower? So even though it gives you some sort of a gauge on what you're getting, it's still the foggy windshield that matters. And you still have to predict the future. It all comes down to predicting the future. If you can predict the earnings, you can tell whether they're priced correctly or not, and then you can easily decide whether they're high or low, and then make your trades based on that. So you kind of can use it as a judge. Of course, the company is new and doesn't have earnings. Well, you don't have a PE ratio. But you can kind of use it as a judge on where you're at. But it's got to be forward earnings, otherwise it's kind of...
and maybe look at their track record.
Well, see
past,
if they're going to continue.
If they've met their targets.
It really comes down to what you think the future of the company is going to be. Are their earnings going to be good for the next year or not? That will get you a good idea of what the price to earnings ratio should be, and then you can adjust whether the real price reflects that. So anyway, yes, you can use PE ratios. It's a little bit complicated. It'll give you kind of an idea. When you see a PE ratio of 100, you know, that kind of tells you that everybody expects the company to do well. You see a PE ratio of 7.
They better be doing really well.
They better be doing really well. If you see a PE ratio of 7, it's probably not doing as well as the other companies.
And what's your takeaway?
The takeaway is a PE ratio can aid in the investment decision-making process, but it's still the foggy future that matters. What will happen in future earnings is what can't be known with certainty, and therefore the feeling of security from doing some math can be misleading.